You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.
This is the Options Industry Council's Wide World of Options. Before we start today's show, listeners should know that options involve risk and are not suitable for all investors. Individuals should not enter into an options transaction until they have read and understood the disclosure document, characteristics and risks of standardized options, available by visiting the OCC.com or by contacting your broker, any exchange on which options are traded, or the Options Clearing Corporation at 125 South Franklin Street, number 1200, Chicago, Illinois, 60606. The Options Industry Council is an industry resource provided by the Options Clearing Corporation, collectively OCC. Any strategies discussed are strictly for illustrative and educational purposes only and are not to be construed as an endorsement or solicitation to buy or sell securities. Commissions, fees, margins, interest, and taxes have not been included in any of the examples used in this show. These costs impact the outcome of all stock and options transactions. Consult your tax advisor about any potential consequences. OIC was created in 1992 to educate investors and their financial advisors about the benefits and risks of exchange-traded equity options, and the Wide World of Options radio show is one of several resources investors can utilize to learn more about options. Other resources OIC offers include webinars, articles, and self-guided options-related coursework. For more information, check out www.optionseducation.org. Now, here's your host, Mark Benzaquen.
Hello, everyone, and welcome to another episode of OIC's Wide World of Options. My name is Mark Benzaquen, and joining me once again in the studio today is my colleague, Roma Colwell, a 27-year options veteran with roles ranging from floor broker, market maker, and risk manager, among others. And now, lucky for us, a fellow options instructor here at OIC. Roma, welcome back.
Thanks, Mark. I'm very happy to be here.
Roma, as you know, the focus here at OIC is primarily centered around equity options based on individual stocks or ETFs. But equities aren't the only game in town, are they? Traditionally, the big banks and hedge funds have always been attracted to the indices, whether it be the S&P, the NASDAQ, Dow Jones, Russell, etc. And now we're seeing more and more individual investors being attracted to the index product. And since you're going to be presenting an OIC webinar on this very topic, I was hoping you could help shine a light on some of the similarities and differences between equities and indices, as well as talking a little bit about what might make index options attractive to trade in the first place. Sound good?
Absolutely.
All right, so let's start, Roma, with the most important and fundamental question. Is it indices or indexes? Which is correct?
Oh, Mark, that is such a good question. And like many of you, I wasn't really sure of that answer either until I went to SIBO's website. And right at the top, if you want to look at their index products, it actually says indices. So it's definitely indices coming from those experts on that product.
All right, excellent. Now that that's settled, let's turn to the basics for those listeners that might be new to options. First, what is an index and what are the similarities with equities?
Right. So an index is a basket of stocks. And that basket of stocks could be, for example, the S&P 500, which are the 500 large cap stocks. The Russell 2000 is, the small cap, 2000 small cap stocks. Now, one of the differences is actually you can't trade an index, right? There's a number for it, and which is actually why there are futures and options against that.
So when you're saying you can't trade the index, you're meaning you can't buy shares of the NASDAQ like you could shares of, say, IBM, but you can trade options on the basket of stocks, as you mentioned. You can trade futures on that basket, et cetera, but you can't trade the index itself.
Exactly.
Okay.
Yeah, and another difference is actually when you're talking about options, is that you can't, if you have an option and you exercise your option, you do not deliver the basket of stocks the same way you would deliver, the equity that you were trading.
Okay, and then what you do deliver is cash, which is something that we'll get into a little bit later. But so the similarities between the indices or trading index options versus your standard equity is simply that they work just as they normally would. You buy a call, it's your right to purchase shares. When it comes to an equity in the index, your right to receive a value equal to the intrinsic value,
Right.
Which again is something that we'll get into a little bit later. Okay, That's, the index, as you mentioned, is a basket of stock. Let's get into the differences, because that's really what differentiates the index options versus equities. So differences between the two. Okay, so that's the similarities between equities, and that's a definition of what an index is, that basket of stocks. Let's talk a little bit more about the differences, or what really differentiates indices from equities, namely settlement and exercise style. What would you say option traders should know when it comes to trading index options, how they differ from equities?
Yeah, well, probably the most significant difference is how they settle. If you're trading an equity or an ETF, it's going to settle into that underlying product. When you're trading an index, there is really no underlying product, right? You have this basket of stocks, but you can't trade that index. So it actually settles into cash. And that cash is derived by, whatever strike you've chosen, how much premium, or what the intrinsic value of it. And that's exactly how it's going to settle.
Okay, so the intrinsic value you mentioned, this is, I think, an important differentiation between equities is, at the end of the day what your shares of IBM are worth. You see the closing stock price. Because this is a basket of stock, it would be the value of each and every one of those components, whether it be 500, in the S&P, whether it be 2,000 in the Russell. So it takes the closing prices of all of those and then uses a weighted average to calculate the value of the underlying index. And that value is what we use to determine the intrinsic value based on the stock price. So instead of a XYZ stock closing at $100 and we've got a $95 call, so we know there's $5 of intrinsic value. Here you've got the index, let's say XYZ index, closing at 3,500, and that would be the weighted value of all of those components in that basket that you had mentioned. So 3,500, you've got a 3,450 call, right? It's $50 of intrinsic value. If at expiration, that's where the index closes, then you would receive $50 cash times the multiplier, of course, per option contract. That's how that works.
Right.
That's what you mean by that cash settlement based on that basket value.
And minus whatever you paid for that
Certainly.
option. Yeah, so another significant difference is with options, you have, the deliverable is 100 shares. With indexes, we actually have a multiplier, and that multiplier is 100. So when you're looking at the cash that you're going to receive, you would multiply that by 100 for that index.
Right.
So that is, one of the difference in terms of settlement. Another difference is the American versus European, right? So the American, which is our equities and ETFs, you can exercise them anytime before expiration. Where our European options, you have to wait until, expiration happens.
Right, which is one of the things that attracts these hedge funds, these Wall Street banks. They don't have to worry about early exercise.
Right, exactly. And for those of you, like myself, that sometimes may get confused over what American style is and what European style is. American style is probably the best way to think about it. You live in America, and we are free to exercise our options anytime before expiration. The European, on the other hand, is not free to exercise. They actually have to wait until expiration to decide what they're going to do with that option.
Okay, and obviously the American versus European isn't a political statement.
Right, exactly.
Right? We're not saying that Europeans don't have freedom. We're saying when it comes to exercise style, Americans you can exercise at any time. European, obviously, only exercise at expiration, which again is something that really attracts those Wall Street banks. And one of the reasons, when it comes to an American style equity, you've got to worry about dividends, for example. Dividends may trigger an early exercise. Now, that basket of stocks, while it may be made up of 500 different individual companies that may pay dividends, and that may affect that exact stock, but because it's part of 500 others or 499 others, everything's kind of aggregated, the effect of that dividend kind of gets smoothed out, right? It doesn't really affect that index as much as it would that individual stock.
Yeah, that is absolutely true. And I would also include earnings.
Oh, yeah, good point.
Right. So when you go into earnings, it's going to, of course, affect the stock that's about to have earnings on it, where, again, because there's, it's a large group of stocks, it's not going to have a significant impact on it. I would say that, a lot of times people will look at indexes as being a little bit more stable.
Indices.
That's right. Indices, just a little bit more stable because they're not subject to these earnings or dividends or whatever news is in these individual stocks.
Right. You don't have that significant outlier of a particular, Apple or, something like that may have a big swing, or Amazon may have a big swing because of earnings. With the individual stock, obviously, it's going to be impacted greatly versus get smoothed out in the aggregate of that basket you had mentioned with the index.
And then I would say the other significant difference is expiration. So when you're trading an equity and an ETF, right, the expiration price is whatever that last sale is.
Right.
When you're trading an index that the expiration is based off of is actually where each component in that basket closes at. And for, if you're going to look at what that closing market is, for at least the SPX, it's called SET, S-E-T. And so you would want to find out exactly where that price is to know whether or not your options ended up in the money or not. So you can't use that last sell on the index to determine whether or not your options are in the money.
Right. And you bring up a good point, because one of the differences also in terms of expiration is you had mentioned the equity, you based it off of that closing price on, say, expiration Friday. With the indices, if it's a monthly contract, those expire based on the AM settlement, right?
Yeah.
Which means that, well, two things. Number one, it's going to be that settlement value that you had mentioned, the SET, is going to be based off of the opening rotation of those 500 components. Let's say if we're talking the S&P, the opening prices, that's what that intrinsic value, that in the money amount is going to be based off. What it also means is that the last day to trade that contract is the day before. So that Thursday would be the last day of trading for that Friday expiration. Now, is that the same for weeklies as well?
So this is probably the one thing when you're trading these index options that you really have to be aware of. This particular expiration that Mark just described is our standard expiration. It's the third Friday of each month. And these indices stop trading on Thursday, right? Those options that are expiring, and they actually don't close until that basket of stock on that opening is determined. So you do have risk, overnight risk there if you're holding an option that is going to expire the next day.
Right, that AM settlement.
That AM settlement, you have to keep track of that. Now, if you're trading weeklies or that month-end option, those all are end-of-day closes.
So those are PM settled. So you have that day, if you've got a contract expiring on a Wednesday, let's say, that's going to be a weekly option. You've got through the end of that business day to trade the contract, and that closing price is going to be based off of the closing price at the end of trading rather than that AM settlement. Mm-hmm. And the funny thing is, now when it comes to these weeklies and some of these securities, first we had the monthly options, and as you had mentioned, the end of month, quarterlies, et cetera. Then we had Friday weeklies. Now we've got Monday, Wednesday, and Friday weeklies. Now we even have Tuesday and Thursday weeklies with some of these more popular securities. So really, with some of these securities, every day is an expiration day. Understood. Excellent, Roma. Thanks for clearing that up. So let's shift gears for a second and talk about, rather than product specific, let's talk about options in general. One of my favorite things about options is that versatility. And for those listeners that have heard our previous podcast, you know that the versatility of options, the fact that we could meet our financial objectives, our investing objectives in a manner of different ways, whether it's generating income, looking for price speculation and leverage, or my favorite, risk mitigation. Using the indices and a protective put, right? That's the risk mitigation strategy that options generally provide for us. Using a protective put with a basket of stocks rather than an individual. Look, if I own 1,000 shares of XYZ and I'm worried about what's going to happen to that, I might buy a put to protect that investment. Mm-hmm. But if I wanted to protect my entire portfolio, then I might look to the indices to find an index that closely mirrors my portfolio, right? And I can protect my whole portfolio that way using the put. Let's talk about that. How does that work?
So I agree with you. Love the protective put. And how that applies to your portfolio, as you mentioned. If you're holding a portfolio, and let's say, I'm going to say a $10 million portfolio, just to make it a little bit easier. So if you're holding that, the first thing I want to do is look at the market and which one of these indices tracks what I have. Do I have like a large technology portfolio, right? Then I might look at the composite, NASDAQ composite index.
Right.
If I have these large cap, if I'm holding blue chips, right? I might even look at, what's going on with the Dow and that index. So first thing I'm going to do, like I said, is figure out which of these indices fits my portfolio that I'm holding. So we now know that we have this $10 million portfolio. I'm just going to look at the SPX because this is a broad portfolio, all largely large cap stocks. And what I'm going to determine is how much protection do I want? I have $10 million. How much protection? If I want a protective put, what put makes sense to me and what can I afford? And sometimes that's a give and take because it's expensive to keep buying. So if I'm looking at my, $10 million portfolio, I might say, for example, right now the SPX is trading around 4,000. I might say to myself, you know what, I think that I need protection. I'm willing to kind of say, all right, $2 million, I'm willing to let that go, but I certainly want protection on my last $8 million.
All right. So you're looking for protection against a greater than 20% move to the downside.
Right. So I'm going to start with that strike, 4,000. There's something called notional value. So I really want to find out what that notional value of that 4,000 strike is. And it's as simple as timesing it by that multiplier, right? So that's giving me protection of $400,000. That's my protection if I buy one option. So if I'm trying to protect this $10 million policy, I am actually going to have to buy 20 of them. Did I do the math right?
So let's see, $400,000, and we're looking to protect $8 million. Yeah.
Okay.
That checks.
Right. So we're going to have to buy, 20 of those. Now I go and I look at the premium that I have to pay for that. So now I'm looking at this premium, and the premium, could be, $100 an option, and I need to buy 20 of those. So now I'm looking at paying $200,000 to protect my investment. Maybe that's a little bit too much. So then I'm going to have to go down to a lower strike to figure out where that balance is between protection and how much I'm willing to pay for that protection. The walk away from this is you really got to check, first thing, what that notional value is. Second thing, you got to figure out how many of those options you're going to buy to protect your portfolio. Now, if I wanted to protect all $10 million of my portfolio, then I'm going to have to buy 25 of them.
But by choosing, you pause. The thing about the puts is you want to protect 20%. So you take whatever that the at the money is, and then subtract 20% from that. Okay, so Roma, so what we're talking about with this protection, let me see if I understand this right. We've got our portfolio, and it's worth, in our case, $10 million. The index is trading at X amount of dollars. We're looking for protection against greater than a 20% downward move. Mm-hmm. So we take where the index is trading right now, subtract 20% from that, and find the strike price that corresponds to that 20% reduction. That's what we use for the notional value. Mm-hmm. And then from there, we figure out how many puts we need to purchase in order to cover that $8 million worth of protection. Okay. And then there's also the time factor, right? Do we want the protection for 30 days? Do we want it for 6 months? Do we want it for 2 years? And obviously, it is with anything else, time is money. So the further we go out in time, the more it's going to cost us. And that circles back to what you were saying, not only about what we can afford, but what are we willing to pay? I mean, are we willing to pay, $200,000, $1 million, what have you, for 6 months worth of protection for this? Or do we, we only want the protection as long as we need it. We only want to pay for what we need. So all of those, it again circles back to what you had mentioned about kind of a balance between what we need, what we want, and what we can afford. Mm-hmm. Okay. Excellent. Roma, wonderful information. Thank you as always.
You're welcome, Mark. I've enjoyed my time here.
And thank you to all of our listeners and supporters out there. Before we sign off, I want to invite everyone to register for Roma's upcoming OIC webinar, which will take a closer look at index options, including the concepts that we discussed today. You can register on OIC's website at www.optionseducation.org to attend the live presentation or view it on demand as well. And as always, please feel free to send us your questions via email at options@theocc.com or live chat with us on our website. Thanks again to all those listening. Thanks again to Roma for joining me, and we'll be talking with you again very soon. Take care, everyone.
You've been listening to the Options Industry Council's Wide World of Options. If you have questions about anything you've heard on today's show, Email options@theocc.com or visit www.optionseducation.org and chat with OIC's Investor Education team. Interested in connecting with OIC on social media? Subscribe to the OIC YouTube channel, like them on Facebook, follow them on Twitter at options.edu, and follow their page on LinkedIn. Thanks for listening, and be sure to tune in to the next episode of Wide World of Options.
You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions@theoptionsinsider.com.